Hi guys, welcome back to the channel. In the looming shadow of a potential banking crisis, the global economy and financial market brace for significant impacts. The warning signs are clear. Financial bubbles, latent capital losses, opaque markets, and substantial public deficits are all contributing to the growing fear of a financial shock. The persistence of high interest rates and inflation, reminiscent of trends from decades past, are seen as slow poisons to the economy, potentially leading to a financial crash in the United States. The banking sector is particularly vulnerable due to the recent history of rising interest rates, which have led to significant declines in the market value of U.S. Treasury and government-backed mortgage security. This situation has already resulted in massive credit losses for financial institutions. Although the government's aggressive response has somewhat stabilized the banking system by pumping a bunch of money in the economy, which is why I've said before in previous video that this whole stock market booming thing it's fake. It's fake money. It's just the government manipulating the market, all right? And yet and still the markets remain under considerable pressure. The potential for more bank failures looms large, particularly in the non-bank or shadow financial systems, as the economy's growth continues to slow. As of May 29, 2024, the Federal Deposit Insurance Corporation, the FDIC, reported that at least 63 U.S. banks were on the brink of insolvency, up from 52 in the third quarter of 2023. Some economic commentators have warned that the closure of the Federal Reserve Bank Term Funding Program, BTFP, on March 11, 2024 could lead to a series of events that could damage the economy. These events include: if cross-border credit and investment dries up, it might increase the risk of bad credit. So basically, like we just saw earlier last week, as Japan basically almost crashed the U.S. stock market. The longer the interest rates remain high, the greater risk of financial trouble. All right. So also stringent credit standards that could lead to challenging banks' weak loans and affect consumer demands, and businesses may have weaker demand for loans. Also, office space demand. Demand for office space may plunge. The potential banking crisis is expected to have profound effect on the economy and markets. A sharp contraction in consumption and business investments could push the economy into a severe recession, with GDP potentially falling by more than 4% in 2024. The employment rate could rise up to 8%, leading to a wave of foreclosures and a drop of home prices as homeowners face job losses and negative equity. Well, if you are in the market to buy a house right now, if you feel like you're priced out, this might actually be good news for you. The stock market are also likely to suffer, with significant declines in stock prices anticipated. The S&P 500 index, for instance, could experience substantial losses as investors' confidence wane and financial instability persists. The office real estate sector, already struggling with high vacancy rates due to shift towards remote work, faces additional challenges as interest rates rise. With a significant portion of securitized real estate loans coming due, the risk of default and renegotiations is high, further straining the financial system. To mitigate the crisis, it is expected that the Federal Reserve and policymakers will need to provide a comprehensive backstop to the financial system, similar to measures taken during the global financial crisis. This would include guaranteeing all depositors and the debt issued by the bank system to stabilize confidence and end bank runs. So basically bailing out these banks like we did back in 2008. Such action could eventually lead to a slow recovery of the economy, but the path forward remains fraught with uncertainty. The potential banking crisis ahead underscores the need for vigilant monitoring and proactive policy measures to prevent a repeat of financial disasters and to safeguard the economy and markets from severe disruptions. But honestly, to be honest with you, I don't think they're going to do any of that. I think they're going to continue to print money, continue to prop up these markets until they can't anymore. Now, the problem is if more of these banks fail, it's going to be really bad this time. I mean, worse than what we had back in 2008. This is going to be a terrible day. All right. So that is going to be all for today, guys. Let me know what you think in the comment section below. If you find value in this video and this content, please hit the like button, share, and subscribe to the channel. I will see you soon.